The investment strategy is a critical component of an SMSF that should allow a fund to achieve the goals of its members. Neil Sparks from the SMSF Association has joined me today to discuss this topic. Welcome, Neil. It's great to see you.
Thanks, Darren, and thank you for the opportunity to talk to your audience about investment strategies and self-managed super.
It's our pleasure. So let's get into it. I might just start sort of right at the beginning. What are the basic elements that should be included in an investment strategy?
Oh, it's a great question, Darren, but I'd probably go back a step further, and that's the question is, why do we need an investment strategy, and have we given it proper consideration? And the only reason I go back to that point is because when we think about superannuation, we know there's a lot of rules. And when we think about that, with a self-managed super fund, those rules are usually contained within the fund's trust deed. But of course, the obligation to have an investment strategy is actually one of the SIS covenants. So what that means is pretty much an unwritten rule. So these things is something you must comply with, but it's not specifically spelled out in any fund investment strategy. So I feel like it could be very easy for a trustee to overlook that need to have an investment strategy. The other complicating factor with an investment strategy, it is sort of captured as a product under corporations law. So it's not something where you need to be licensed to support someone in giving advice on how to properly structure their investment strategy. So a lot of providers will give a template. Now, a template's great because it means people can actually have a structure to follow. So it's better for a new trustee to have a structure they can follow as opposed to perhaps winging it and getting it wrong. So I think that's sort of like the precursor to it. And if we then go back to the investment strategy, well, really simply, it's a document that sets out the trustees' objectives in running the fund, and it's going to spell out how they're going to achieve their retirement savings objective that they've set for themselves and the other members. And so it can be structured with a template, or it can be quite a fluid document. The important thing is it must be in writing. So it must be something that is down on paper and can be monitored and tracked. Now, the other benefit of that is it's totally adjustable. So if you're looking at the situation and going, I'm not investing aggressively enough to achieve my returns, or the alternative where the markets are looking a bit choppy and I don't want to be so invested, I want to be a bit safer in cash and term deposits, you can simply look at your investment strategy and determine that it needs to be adjusted. And so the trustees can meet and they can adjust that strategy to suit the economic conditions that they're facing into, and then continue to adjust their investments accordingly to suit. So it is the engine in the sports car, but it is something that you can tune and scope to sort of fit where you are in your journey, where the economic circumstances are, and so on. And that might be that you're invested in cash in the markets today, but you're suddenly making the shift to leveraged property tomorrow. So we do have incredible flexibility. And again, it's just one of those really powerful elements of a self-managed super fund. Once you get into those nuts and bolts, then you're talking about what they call the making, holding, and realizing of the fund's investment strategy. So what are you buying? How are you buying it? Once you've bought it, how are you storing it? If it's a physical asset, if it's a share, obviously it's on the market. So all of those different considerations, so diversification, risk and reward, liquidity. You can't put everything into an illiquid property, for example, with a debt attached to it, because you've got to pay fund expenses. So it's that, how am I meeting the cash flow obligations of my fund? So there's a lot to it. It's a really broad sort of thing, but hopefully that sort of captured very briefly that sort of first element of the investment strategy.
Yeah, you've raised the adjustability point and element, and that's a really great point to make, because obviously where you start with an SMSF is not necessarily where you finish. But there is a little bit of confusion around, look, how often should I go back and revisit the investment strategy? Is it every month? Is it 6 months? Is it a year? Is there any sort of rule of thumb that people can apply to when they should review it? And what are some of the events that might trigger a review, which is not a regular review, if I could call it that.
Yep. So there's a bit to unpack there. So yes, there is a bit of confusion. If I own BHP in my portfolio and I want to sell BHP and buy Wesfarmers, do I have to have a minute in my investment strategy? The short answer is no, because it's not so much about those tactical moves that you're making, it's the overarching objective. What are we trying to achieve with our fund to meet our retirement goals of the members? So tweaks inside your portfolio, not necessarily required for the strategy. But we go back to those covenants, and the covenants say that it's the investment strategy formulated. So that's we've designed it, basically written and reviewed regularly. So what does regular mean? Now, for me, best practice means at least annually. Okay, because this is a compliance document that you will have to provide to your auditor, and your auditor will have to sign off that there was an investment strategy in place and that the trustees did follow it. So if you've got a dated document that talks about leveraged property and you've paid off the property and sold it, and now you're invested in blue chip shares, you're going to have a disconnect and a problem. So that's the piece about reviewed regularly in your auditor, making sure that it is actually still in line. So I feel like best practice would be to meet, the trustees would do their end of financial year review and sit down and go, what did we invest in? Did we invest in line with the strategy? Did we achieve our goals and objectives? How was the performance? Risk return, diversification, liquidity, all of these sorts of things. And if it's fine, it's fine. A trustee minute that says we reviewed, so date of the meeting, who was present, we reviewed the fund's investment strategy and the behaviour of the trustees, and it was in line with our goals and objectives, satisfied with the result, date, time, stamp in the file, off to the auditor. Didn't have to change a thing. So, it doesn't necessarily have to be changed every year or updated. It just has to be reviewed. If it's still fit for purpose, away we go. Now, what would be a trigger that would make you look at it in between times? Adding a new member. So if suddenly you've got mum and dad in the fund and they're bringing in their younger adult children, and those younger adult children have a different asset allocation, investment timeline, risk profile, Bitcoin, all these other things, then you might need to consider and review the investment strategy, because it's about all of the members. Similarly, heading into retirement, the trustees should meet, because if they're 2 years out from retirement, a year out from retirement, they might want to be again talking about the portfolio and how it's going to achieve their objectives, how they're generating liquidity to cover, first, second, third years worth of cash flow in retirement, all of these sorts of things. And the other one is, if markets get a bit choppy, a bit shaky, you might call a meeting to go, do we stay invested? Are we holding course, or are we going to make some tactical shifts and flee to cash and safety? So there's those sorts of trigger events. Now, again, best practice could see a trustee sort of look at the market and go, things are a bit choppy and shaky economically, but we're going to hold the course. And so that's the decision. Strategy's fine. We're holding the course. That's the minute. The auditor's going to be really happy. That's what it boils down to.
Now, Neil, this document should be in quite a bit of detail, I suppose, to be completely effective, which is what all trustees want it to be. But I know that there's always some discussion around, oh, Neil, I've got a solution to that. I'm just going to put I can be in cash 0 to 100% of the portfolio, or I can be in Australian shares 0 to 100%, in which case any discussions like you just mentioned about choppiness of markets or volatility of markets, that's covered. I don't need to do that. But it's not really a solution, is it?
Yeah, this answer is pretty short for me. It's just impossible to have 0 to 100% across a range of asset classes. It doesn't make sense. I mean, number one, we talked about liquidity right from the outset. So what is liquidity? Saying 5% is too broad a brush. I mean, there are some very large SMSFs where 5% will be tens, if not hundreds of thousands of dollars. So liquidity is liquidity. How can you meet your cash flow objectives and so on? So a cash buffer to pay expenses and any outgoings that need to be made. And also there for the assets. If you hold physical property, you need more cash in case there's damage to the property that needs to have some money spent on it, things like that, or maintenance. So 0 to 100% doesn't really work. I think also if you are investing and you're looking across that asset allocation across cash, fixed interest, the markets, and so on, having ranges in there is good. But yeah, I mean, let's be realistic. If you're not going to have a zero allocation to it, then it doesn't need to be there. If you're not going to be in emerging markets, why have it in your investment strategy? And if you are going to be there and the range is somewhere between 5 and 15%, then have 5 and 15%. I think it comes down to the template. So when we have seen a template situation and the trustee without support doesn't really know what to do, so they kind of just leave it blank, for want of a better word. And because the blank document says a range of 0 to 100%, that's the default position we end up with. But you're right, a little bit more thought and consideration into those key points: making, holding, and realizing. How are we buying it? How are we holding it? And how do we sell it? So if it's an artwork or a collectible, which have strict rules around it, how do we buy it? Is it tradable on another market or exchange? Or do I have to find someone else to buy these units? If you think about unlisted assets, I want to sell them. I've got to find someone who wants to buy them. Then we need someone to value them. So all of these things come at a cost. So if you're investing in a private company shares or units in an unlisted trust, your investment strategy really needs to talk to: how am I buying it? What are the trading costs of buying it? How am I reporting on it? Like, how am I getting the valuation each year to support the auditor and support the value? If I want to sell it, how much is it going to cost me to sell it? If I want to sell out early, how am I doing that? Do I have to get the accountant to do the full financials for a business to value it mid-year? So those are the sorts of things that need to be considered. If it's property, then you'll sell it through a real estate agent. There are professional valuers who will do it. So all of those considerations will come into those different asset classes, and that really needs to be captured in the document.
Now, I know it's called an investment strategy, but one of the components that needs to be considered is actually whether or not to hold insurance inside a fund for the members. How does that work?
Yeah, it's a really interesting one. I can't remember what year it came in. It was the mid sort of 2010s, but yeah, they added the insurance requirement into the investment strategy piece. Under insurance is a real problem in Australia. And I think one of the things with self-managed super is people sort of tend to say, if you've got super in your industry fund and you're rolling over your benefit to go self-managed, you can kind of leave your insurance behind. But that's fraught with danger. With the superannuation changes that came in a few years ago, you have to have an active account for it to have insurance premiums debited from it. So if you're not making contributions to that old fund, there could become a situation where they're writing to you saying your minimum balance is too low, your account's inactive after 16 months, we've closed it. Where do you want us to send your benefits? Which means suddenly you're not insured. Other problems are that those group insurance schemes are, they take on all health risks. So it's just presumed that you're healthy when you join. The problem is, if you have a health event before you joined that fund, they underwrite you at the point of claim, and you may suddenly find that you haven't got insurance that you were paying for. And plus, over time, based on hitting certain age bands, they decrease your level of cover automatically. So it's not eroding retirement savings. So a set and forget strategy where you've left your insurance behind may not be the best outcome for you. So I think it is really important that it's considered in the fund's investment strategy. And it's one of those things where you've got to be looking at the insurance needs of the members. So again, considering each member, do they need life insurance and total permanent disability? Do they have a need for income protection? Now, it might be as straightforward as we've considered the needs of the members in the investment strategy, and they don't require insurance through the SMSF because they hold these things personally. right? So if I've got cover in my own name, direct with an insurer, fully underwritten, I've addressed it in my investment strategy because I'm insured outside super. And there's many reasons to have super inside versus outside. If you haven't got any tax dependents, it would be silly to have your super inside, your insurance inside super, as opposed to holding it in your personal name. But if you've got tax dependents and a cash flow perspective, then you might want to hold it inside. So lots of different reasons, but again, for every single member. So if you're suddenly mum and dad in their 60s with all their assets paid off and you're thinking, well, I don't need to worry so much about life insurance, but your 30-year-old children are in the fund and they've got mortgages and dependent spouses and dependent children, well, they probably do. So mum and dad have been ticking along nicely. Suddenly they've brought the kids in. You've actually got to be now, from a trustee perspective, thinking about the needs of those members.
Okay, great. Well, thank you very much for those insights, Neil. They were fantastic.
Pleasure to help, Darren. Looking forward to the day.
Neil will be discussing this subject in more detail at the SMSF Trustee Empowerment Day 2024, commencing in Sydney on the 17th of September and concluding in Melbourne on the 19th of September. There will also be an online component to the event. To find out more about it and register, please reference the details you can see on your screen now. Well, thanks again, Neil, for the discussion, and I'm really enthusiastic about hosting this day for SMSF trustees.
No, me too, Darren. It's going to be a bit of fun.